This is Behind Closed Deals.
We'll be chatting with multifamily maestros,
Uncovering their strategies,
and unraveling the latest market happenings.
bringing you intel you can't buy.
Well, thank you guys for joining us on our new podcast, Behind Closed Deals. So what we wanted to do today was set up someone who's an active buyer, been an active buyer in the market for a while and still looking at deals today, and kind of interview you.
Awesome.
So
I really appreciate the invitation behind closed deals. When I heard you all were finally doing a podcast, very excited, mostly just to get all the gold nuggets that George has to drop along the way. But this is really exciting and big honor that, first operator that's on the podcast.
Yeah.
This is great. We're looking forward to it.
And it has nothing to do with the fact that you have an amazing podcast studio.
Oh.
Yes. We would pick you even if we had to record in the back room.
Exactly.
Using none of your great equipment.
We could be in the closet. Closet, classic little tape recorder. And that's what I was telling you guys earlier. I was like, it's the content, that matters, and that's what I loved your guys' first two episodes. Is that the first episode, especially with George talking about buyers in the market, who's actually transacting right now, it was very introspective for us, because I was like, okay, how do we be the buyers that are competitive, and and looking at the long-term opportunities in the basis, and some of the buyers who haven't been active past couple of years are now coming back into the market, seeing value, and it truly made me just think a little bit differently about the market and our approach, and because we're always thinking about how are we an attractive buyer, to how you all perceive us, to other sellers perceive us, and so really insightful, and it's different from so much of what else is out there. Yeah. So I'm glad you guys are doing it.
Good. Well, we hope we continue to have good content that you guys like. And you said something that you said, buyers who are out there right now have not been active, haven't been active before. And that's in one part true.
Yeah.
But in one part, some of the buyers that have been active, been making offers, but they were offer number 6 or 7 or 8. Those are the ones that are coming to the top. But there are, just as you said, there's groups that are like, I'm not even going to offer because I don't like prices right now.
Yeah.
But there are some that have been there, but they were not active buyers, but they were active offerers, which is very frustrating, I know.
Right.
But they kept going.
Yeah. That's how we feel right now.
Your time is coming.
Perfect.
Your time is coming. Yeah.
Getting closer.
For sure.
Yeah.
So we thought a fun way to start it off would be if you could give a background on Gray Capital. Obviously, we know the history, but for the viewers.
Yeah. I'll do just real quick on Gray Capital, and then Jay finish it up. Gray Capital started the firm in 2015. I had been investing in real estate really since I was getting out of high school, but mostly single-family homes, duplexes. But I didn't really think real estate was going to be my full-time job. I went to music schools, working in recording studios, wanted to do something in the music industry, kind of ran into many dead ends, as you can imagine. Started a business in the craft beer industry, sold that business about 2014 when I started learning more about multifamily properties, investing, and it really was just looking around Indianapolis and other markets, and looking at these big apartment buildings, like who owns that? And I think that seems like it would be a good business without knowing anything. Once I started to try to get started, I quickly realized that even if I wanted to buy a big multifamily building, and even if I could raise the money for it, I wasn't going to qualify for the debt to do it. And I realized that I had to partner up with some folks, and so local bank lender that we all know really well, Merchants Capital, got me in touch with another local operator that you guys also know really well, and we started doing deals together, partnered up as co-GPs, built a portfolio. I brought my family into the process also, because this is a great opportunity. I think we can build a business. And then I decided I wanted to really truly be an operator and start putting our own deals together, not just be a co-GP. That's where Mr. Jay Reeder came into the picture.
Yeah, great segue to Jay.
Because I was like, I know what I know. I know the investment side. I think I know what a good deal looks like. But man, there's a lot of details that I just don't have the experience and Jay had all that experience, and a little yin to the yang. So
I love it.
Mr. Reader.
Yeah, so I joined Great Capital in 2020. My first week was the week that COVID shut everything down.
I remember that.
That's not ominous at all.
Not at all.
Were you like, who did I just hire? The
Yeah.
Grim Reaper, the messenger of death.
I was more worried. Yeah, well, I didn't think about that. I was more worried about Jay being like, "What did I just do?" He came from a big firm, very successful, good spot, and he just took a giant. He took Jay always deserved an incredible amount of respect, as he took a massive leap of faith, jumping over, with us when it was just myself and my wife Alex.
Yeah.
And we had things going on. We had done deals and partnered. We never done our own deal. And Jay, took a big risk.
Where were you guys officing at that time? Because you're in this beautiful space now.
So Jay's first day, we officed at BAM's headquarters.
Oh, right.
Capital.
Okay.
And
Yeah.
I was we're good friends. I'm like, yeah, sure. Take a cubicle that's empty, and then we started officing out of my dad's house for a while because he had some extra space, and then everything shut down.
Yeah.
And so then we were in our basements for the next.
Well, yeah, you didn't really have a choice then.
Didn't have a choice.
Yeah, I remember we did a property tour actually with you on that Friday, and I remember going home, and on the drive home was when Governor shut everything down, and I remember you and I didn't see each other in person again for like another 3 months.
Yeah.
And so it was all like Zoom and phone calls. So we talked every day. We were working on documents together using Google to kind of keep everything updated. But yeah, we didn't see each other in person again for like another 3 months.
Yeah.
That's crazy.
Yeah. It's a fun time to start a business.
Yeah.
Get things started.
It's a great time to start a business.
Yeah.
Yeah, truly.
It ended up being the best time because we're doing this. Like
That's right.
we're not changing course. Like I've got some responsibility. We just brought somebody on. He just left
Right.
his job. Plus, we still felt that there was a big opportunity in the market, and then our next deal that we were able. The first one was 2 West at the time. It was a smaller condo deconversion, which you guys ended up selling for us successfully, and then Autumn Trails, which is another smaller deal that ended up coming back around. Because in COVID, I think their financing fell out. I think they were going for a CMBS execution.
That's right.
CMBS
Yeah.
market, died, and we got the call. And you guys called Jay, and we ended up doing 3 deals in 2020.
Yeah.
Which the first 2 were small, smaller, and then the huge opportunity at the end up in Grangerville, Villas on Fur,
Yeah.
which was a great challenge for us at the time. It was 6 times more money we'd ever raised at a given time.
Huge. Yeah.
Massive. The seller was unsure we were able to do it. That was fun. That was a driving force.
Which is how it all happens for people in the beginning.
Yeah, so who
but
are
that
we?
was, and I've told you this story, Jay, I was like, that's when I always had a great deal of respect for you and knew that you were super competent. But during that deal, I was like, Jay's got a major backbone, because we were quizzing, the seller was quizzing you guys,
Yeah.
like, can you get this done? And he's like, you should not have picked us
Yeah.
if you did not think we could get it done.
Yeah.
And just sort of let the mic drop with that. And I was like, you're right. You're right.
Yeah.
Yeah, I'm like, we believe you
But
could get it done.
Yeah.
Yeah. So you guys executed on that beautifully.
Yeah. Well, and on that, I mean, we owe so much thanks to you guys. Gratitude for trusting in us, or thinking that we had the ability and to follow through. And that was a lot of the pressure is not only do we don't want to let ourselves down. Obviously, we've got money at risk. We don't want to let the seller down because they're a big developer, local developer. But the last thing we want to do is let you guys down also, because from a buyer. One, you guys have an incredible amount of deal flow, in the, Indiana Midwest market, and, first impressions mean a lot. And even we had done a deal earlier that year, fallen flat on, a much larger deal, even in kind of interesting times in COVID, would not have been a great first impression. And so we thought opportunity, maybe do the opposite if we can get it done, get it closed. And we ended up forming a great relationship, with the seller, and again, second deal that we could do with you all, under the Great Capital flag. So it was a fun time.
Well, we were
20
impressed,
ago.
and so was the seller. Yeah, we felt conviction that you guys were going to perform, but you, as you said, you purchased it from a really large Indianapolis-based developer that has properties nationally that sells probably 10 to 15 deals a year. Their average deal size is probably 50 to 60, $70 million, I would guess. And so, but like I said, you guys absolutely just did amazing, performed phenomenally, and I think that's been one of your best deals.
That it has.
It has. I mean, we've done a lot of deals that we're really proud of, since then. But I mean, if like we could have done just one deal and like wanted to hang it up, that would be the deal. I mean, it's one of those. It's a beautiful property. It's new construction. Class A asset, and sometimes you look at you can just look at a deal and you kind of imagine what the returns might be, just because nice and new. Probably going to get what you pay for. It's probably not going to be the highest return because it's a good location, high quality. But that deal in just the first year threw off over 10% cash on cash return. Again, 2018 to 2019 construction, Class A. It's been throwing off 13% cash on cash.
That's awesome.
Every single year. And I mean, we refinanced it in beginning of 2021, locked in at 2.7%, HUD 35-year term.
Locked for 35 years.
Yeah,
That's
so
great.
we're like, it's again, we're looking forward to doing a lot of more great deals together. But it's like, man, if we just could have done one, that's it. That's
Okay, so
great.
they answered our next question, I think.
It's already there. Best deal.
That's the deal. Yeah.
I mean, I would say, obviously, for obvious reasons, I would say that's our best deal. But I think it goes more even than what Spencer had said from the standpoint of it's performed great. I think it kind of helped us understand and build what we could do with this business, because I remember the first two deals we did, like Spencer said, smaller deals, equity raises on those were pulling teeth.
Yeah.
Yeah. Hardest raise to date. Yeah.
And I remember him saying to me, and that's how we even started looking at villas. He's like, man, like asking these people for this size check. He's like, I'm gonna have to have calls like this all the time. He's like, I want to just call someone and I want to try to raise $1 million at a time. And I remember saying, like, how bad do you want to try to do a larger raise?
Yeah.
And he said that. I said, well, then I have a deal that I just underwrote, because this was kind of in that time where we hadn't seen each other day to day very much. And I was like, George and Hannah just brought this deal out. I kind of disregarded it at first, but like,
it seemed too big.
Because it seemed too big. Yeah.
It was 6 times the amount of actually at the time we thought it was even going to be more equity, and so it was many multiples, probably 8 times the size of our previous raise, and so it seemed a relatively insurmountable number. But yeah, what Jay was alluding to is, all right, if raising $100,000 is easier than raising $100,000 is easier than raising $10,000, because you start talking to different
That's
people.
Right. Mm-hmm. More sophisticated.
More efficient.
Deeper pockets.
Exactly. I think maybe the $10 million may be easier than the $1 million, and it absolutely ended up being the case as we started talking to a local wealth management firm, RIA, who thought it was a great deal, and they've turned into a great partner for just deal after deal after deal. But it just forced us to have the right conversations, and it's a lot of it's just setting goals. If you're going to set a goal, might as well set a big one.
That's right.
A similar amount of effort.
That's right.
And that's proven to be the case time after time again. So
that's awesome.
Yeah.
So off of that, what do you think your toughest deal has been up to this point?
Are we my toughest at Great Capital or the toughest one I've ever done?
That's a good question. We were thinking Great Capital, but if you have a good one, then maybe that one.
Well, because we don't have any too tough deals at Great Capital. Just kidding. No, there's always at least one, if not 2, if not 20% of our any deals portfolio. But Jay probably has.
I would say probably my toughest deal is not one I did here at Gray, but I had one. My former firm was kind of heavy in the affordable housing space, and I remember doing a property tour, and it was location in the southeast, and I remember going to the property, doing the property tour when we were kind of going through initial looks at it. Gorgeous property.
Not affordable or affordable?
It was affordable.
Okay.
It was a tax credit, but it was outside, looked very, very well maintained. financials look great, even with we were going to be doing the extended use, so that there was still a little bit of runway on where we could get rents to because of some of the rent options opening up. They had a big rent bump in the area so that you could get the AMIs way up at the time we bought it. Financials looked great. Ended up going through due diligence. Everything went pretty well, and then when we bought the property, all of the issues started coming out. Well, what we found out is they had been doing a number of things to mask the performance of the property. The previous owner actually owned a market rate deal across the street that they were rehabbing. And so what they were doing, normally you catch on CapEx that, hey, they're spending a lot of money in this area. What's the deal there? What was happening is they were scrapping out the water heaters and HVACs over at the market rate deal and just bringing them over.
Yeah.
And so they were masking the fact that there was even a big deal with it, and we only found out it was a big deal because a couple, the maintenance tech stayed on with us. The supervisor didn't stay, property manager stayed, but one of the techs was oh yeah, they've just been bringing this stuff over.
No big deal.
And a bunch of stuff like that to make the property look really, really well. They built up these big beds. Well, they clogged all of the drain lines, and so there was water backup in the water heater drain lines and the condensate lines, and so it was a huge mess. And
financials, just the whole impression of what CapEx from an HVAC perspective, but then just immediate just repairs and just mess.
And then on top of that, this was obviously in the southeast. The company I was with before had never had any sort of hurricane claim or wind damage claim or anything like that. Owned this property for 3 months and had a hurricane claim with all new roofs. And so it was just, and it felt like all of a sudden occupancy dropped way down. It was 70-80% occupied. We were doing all of this marketing to try to get there, because when we went in extended use, it wasn't necessarily on the local registry for tax credit deals and where people were wanting to go. And so we had a hard time marketing to the right demographic there, and I just remember meeting after meeting after meeting every week of trying to kind of turn it around. Now I think they have since sold out, and they did fine because they kind of sold out as the market changed, and I think its extended use wore off, and I think they were able to sell it as a market rate deal at the time. But I would say that's probably the deal that I bought that has given me the most headaches in my career.
Yeah.
I imagine you were happy when you didn't have the deal.
I was this doesn't coincide at all with when you decided to leave, right?
It did not coincide. But
From that deal to Villas on Fur.
I know. He's he's come along.
About a year.
It'd come a long way. That's right.
So how has your view on the view on the market has changed, right? From low interest rate environment, buying villas on Fur, to today, the rates have been pretty volatile. How has your acquisition criteria changed?
In some ways it's changed a lot. In other ways, it hasn't. I mean, we're still looking at 200 plus unit, high quality, market rate, good locations. What's really changed is the rate environment, and then the returns and the return expectations from investors, and a little bit of is acknowledging that no one knows what the future is. We don't know where things are going to go, but trying to maybe look back in the past of where maybe things should be today and might go. So the hard time we're having today is we see risk has been increasing. The risk-free rate, which is basically the 10-year treasury, that's been going up, but returns are going down. And there is so little price discovery that's been going on. I mean, the deals that have traded, you guys have been selling deals all throughout this year, so it's not like the market is frozen, but a lot of the transactions have been still at decently low cap rates. There's still a good amount of capital out there. Some of it is almost forced buyers. They have to spend either 1031 exchange money or discretionary capital that needs to be placed, kind of need to invest it, or they may lose it. And then sellers that are a little nervous, but they're also generally well capitalized if they've been in the market the last couple of years, and they're not too eager to I think admit defeat too quickly. And so as long as there's still some buyers out there, things have been getting moving along. All at the same time, there's a big balloon of loan maturities that are going to be maturing over the net, really from now through 2024 and a little bit of 2025, and we think that that's going to spur some price discovery, more transactions, just because terms are due. Some lenders may modify the loans and extend things to a certain point, but if we are in a higher for longer interest rate environment, kicking the can down the road a year may not really end up working out. So we think at some point, whether it's Q1 next year or Q4, who knows, there's going to be some pickup, in volumes, and we're going to learn more. And just like with George, I was listening to the podcast, last week with George. It wasn't too long ago that cap rates were in the sevens, and that
it was longer than maybe he said. It was about 10
Yes.
years ago, realistically.
Yeah.
It was about 10 years ago.
No, it
Yeah.
sounds about.
When you have a 40-year career, though, like George, you're like, it was like 5 minutes ago.
It seems like
it was like,
Yeah.
cap rates were 7%.
But
5
it's
minutes ago.
But when
Yeah.
the last time interest rates, were 10-year was close to 5 was about 10 years ago too.
That's right.
And so but there's also a lot of demand, not only for on the renter side, rents have never been more affordable relative to mortgages. So there's still a good amount of demand. There's still a good amount of demand. There's a lot of supply coming online at the same time. But looking at where interest rates are, should we be closer to 4.5, 5, or closer to 7? And that leads us to think, to be advantageous, we should want to be closer to 7. And I feel sellers who are just now getting comfortable with, we'll sell for a 6.
Right.
And now where the buyers are like, well, I know we said 6 a couple months ago.
I know, now it's 6 1/4.
Now it needs to be 6 1/4, or we were going over a model yesterday, and we're like, the math isn't working. Okay, where would it need to be for us to be excited? And it was in a 7 cap
Yeah, it was 7
range, and I'm like,
Was this like workforce, or was it?
No.
Okay.
No.
Yeah.
And that's the thing. It's like what seller is like, oh yeah, I'll take a 7 cap
Yeah.
because no one's making any money at a 7 cap.
Yeah.
And so there's this big gap between buyers and sellers, and so from the buyer side, we're how do we get creative? Are there different ways to look at it besides just it is what it is? And that's where, again, listen to your podcast, your all's podcast last week. It's what's the priority? Is it a basis and a long-term hold, and looking at replacement costs and understanding, our base case isn't really attractive and, a home run. There's no home runs that you can underwrite, realistically right now. But, risk adjusted, it might not be that bad depending on where else you can go. But from a return standpoint, it's still it's not exciting. And when you have to go out and raise capital, you want to have an exciting story and some good returns to go along with it. And so, we're exploring different strategies, on how to be competitive. How do we buy basis but not allow financing to get in the way? And so we've even discussed doing all of cash transactions, which is a big lift. But if the variable of interest rates and financing is the one piece that's kind of getting in the way, if you can raise the capital, buy for cash, get a great basis, great assets, great locations, and then when interest rates come down, you can look at refinancing, pulling all your cash out, de-risking the asset. But that's also it's a big lift when you're looking at 40, 50, 60, $80 million projects.
Yeah.
Well, that strategy because Cameron told me that you guys were talking about that. I'm like, that will work so well for somebody who thought they were going to have a refinance.
Yeah.
Or perhaps had another buyer lined up, or had another plan, and you can go in and close in 21 days.
That's exactly.
And so
speed
of execution. So your silver bullet in that execution will likely be speed. It's probably not going to be price.
Exactly.
But
yeah.
You guys, and that was it's like they've got us all teed up for our questions.
I know.
The next question we were going to ask you about is your loan maturities report.
Yeah.
And so you get somebody who's at the end of their rope that has a loan maturity, thought they were going to get a refinance, had another sale, had something else, and needs to close almost immediately. You guys could be that life preserver that they need to get them out.
Yeah, that's the thought, is being able to move quickly, and just like you said, you price or terms. You
Right.
usually can't have both, and so if we can
You used to in 2021, but those days are over.
Well, yeah. but think back in 2021, it's, who you kind of had to be ready to go. And I'm thinking of some of the buyers who were very successful and acquire a lot of assets. And I don't know how they're all financed, but some really well. But it's because they can move so quickly.
That's right.
And it was the only way. But it's like, look, everybody's at the price. But they're going to, we know they're going to close. Surety of close, and they're going to do it in 30 days or something. And at the time we're like, well, we can't close in 30 days. There's just no way. I mean, just because if you're doing an agency execution, there's just a certain amount of work that you have to do and the lender has to do, and 30 days is typically not enough. I mean, 45 days can be. I mean, we like 60 days gives everybody a little bit of time. 45 days is doable. And so if we can move quick, but we still the environment still has to be right. Someone's not just going to move quickly, but as just another tool in the toolbox, another strategy for acquisitions, because it's not the typical strategy isn't working as well, just the numbers as it did a couple of years ago.
That's right.
And talk about it to the team. I'm like, we could be in a year from now. We could be having the same conversation, and so we need to be thinking outside the box, just different ways to go about it, just different ways to execute. And so we're thinking about all cash. We're looking at just land right now for development opportunities that aren't going to get started for another year or so. But there's exciting things going on in the Midwest and around Indianapolis that we're just highly convicted of, and we're really excited about. The reason why I got into real estate really to begin with is I like being part of building communities, and I driving through Indianapolis, my hometown, and seeing neighborhoods that are being fixed up, and it's like that's exciting. And I want to be a part of that.
That's right.
And so when I see communities like I really care about, we like to invest all the Midwest, but see communities that we care about that are growing, if we can be part of that progress and that growth, and it can be part of our strategy that we would have never probably pivoted to, because we had a successful strategy that we're like, why change anything? We've got a great system. Let's keep doing it until it doesn't work. And it may work in 3 months from now, but today it doesn't necessarily work. And we want to be around here for a long period of time. We love this industry. And so let's think differently. Let's be creative and see what we can do. And so we'd still like to keep buying deals from y'all ready to go. But
well, having that creativity that you talked about, or being willing to pivot. Think about what you said earlier of you guys starting in the beginning of COVID. You're like, okay, we have to pivot. We're going to work out of our home offices for the next 90 days. We're going to go work in a basement for a little bit. So the groups that are getting things done, both from our side, from the brokerage side, and also from the sales and acquisition side, from buyers and sellers, are those that are willing to see an opportunity and maybe look at it a little bit differently, whether it's structure a deal, whether that's providing financing. We have some sellers that are providing financing right now, or buyers that are willing to say, I'm going to assume a really low leverage loan right now because the interest rate is 4%, and eventually the interest rates are going to adjust at some point, and who knows when. But then they'll be teed up to do that. So the fact that you guys are looking at it from being willing to pivot and look at it from a different lens has helped you stay active, stay nimble. And it's those that have not been willing to do that who are just not doing anything. Yeah. Right now.
And I understand the feeling of kind of being paralyzed, and and just it can be frustrating. But honestly, I was listening back to one of our podcast episodes that we did last summer, and we were having the same conversation. It was last July, and we were having the same conversation about how there's a bid-ask spread, and interest rates are rising, and it's just hard to make deals work. I'm like, man, if I have to listen back next year, and it's the same. I was like that. I was like,
I'm out.
I was like, not doing it. Not doing it. You adapt or you die. And
that's right.
And every business, has to grow, and every person, you just have to adapt to everything. And we're obviously in a different environment, not too dissimilar to the way real estate operated, for decades before.
That's right.
And so we just have to think a little bit differently. There's going to be a transition period. There's going to be some pain. But how do we, take advantage of it today and then get to the other side, because I think that there's a lot of light at the end of the tunnel. I think, again, can't predict the future, but we know 2025, 2026, there's going to be a big slowdown, in deliveries. There's a lot going on right now. I think there's like 1 million units under construction in the U.S.
Yeah.
There's a good demand, just there's more supply is outpacing demand, but that's going to slow down in a couple of years. And so we think that the herd may be cold a little bit, maybe less buyers, and people are going to just be exhausted. And this is probably wishful thinking, because there's a lot of really smart people in this business longer than us. But if it's a little less competitive, there's been a lot of new entrants, including us, in the last couple of years, and we'd love to have a competitive advantage of just not being as many folks and be able to buy a bunch of great real estate from you guys.
Yeah.
Yep. When we went to NMHC this year, there was a broker out of Florida that was an active broker there that said 2023 is the year of the basis buy. Said people who are buying this year are buying because they remember prices were higher last year.
Yeah.
They're not doing it because there's a great IRR, great cash on cash year one. They're not spreadsheet buyers. They're just literally going to look at the property and say, I can't believe this is $175 a door when the neighboring property sold for $210 last year.
And I'd say I've seen that a lot in my underwriting as I do that, and I agree with that to an extent, but I think one thing that's lost in that as well is just the cost of expenses right now.
That's
and I've had some deals where I've had a couple things pitched to me that were 2020 construction, 2021 construction, like, oh, it's 160, 170 a door. I'm like, yes, please, like, give it to me. And then I run the numbers and I look at taxes, I look at insurance, and I'm like, I'm barely at break even. And I just, as much as I want to be like, yes, I want to buy 160, 170 a door, to what Spencer said earlier, that's a great basis buy. I know that it will outperform this, but what I put on a paper and put in front of investors, like, the numbers aren't really lying. I unless I completely fabricate the numbers, I can't show an investor exactly what the track from point A to point B is.
And that's the point you all are making on your first episode, is that, like, the buyers in the market right now are, like you just said, not the IRR buyers. They're not trying to hit a certain return, so they don't have to go out and raise capital. And when I heard that, I was like, oh man, are they talking about us? And I'm like, was they're describing us? And so that's where, how do you still have to find that competitive advantage? But it's you want to take emotion out of it, even though emotion is always going to be a part of investing. And so just look, like, the math is the hard part to get your head around, but the emotion part of it, which I don't necessarily think is always wrong, is like, these are great assets and great locations. You can't build it for cheaper.
Right.
I don't think, we're all figuring out what cost of replacement is, it's moving around. But with the demand for rental housing, highest it's ever been, because no one can afford a mortgage right now. If you're in kind of the prime renting demographic.
That's right.
It makes a lot of sense over the next 10 years. It's just, you just have to know that maybe there might be some bumps in the near term. But if you're a buyer.
And if you have equity that's patient or doesn't have really stringent return expectations, because we've seen that in Indianapolis, some of our most active buyers are those that have captive or really their own equity, and they say, okay, I'm buying a deal at $165 a door that maybe 2 years ago would have sold for $200 a door or more. I'm going to be a little lean on the return for the first couple of years because of where my rate is today. But I know that I know where rents are headed, and luckily the top line number is the biggest. And you're going to have some moderation in expenses. Do you have equity that's willing to ride along with you for a year or two at perhaps a lower return, which I know is harder to raise equity for that when people have money in a money market account and getting 5 1/4, and you're like, the first year's going to pay 5, 6, 7%. They're like, meh.
Yeah.
But that's when the equity says that, though, such a short-sighted. And I know I'm sure you tell people this, that you're like, you're missing out on all the other benefits of real estate, depreciation, how your taxes are, how the income is taxed, the appreciation, everything else that goes along with real estate, you're not getting in your money market account. Yeah. Yes, you're getting 5 1/4 right now, but that's also not going to last forever.
I just need to replay that, just over and over and over again to some investors, and a lot of investors, do get that, but some often get hung up on the yield and the coupon, and they're only looking half of the return. But a lot of other investors look at it as like, okay, look, I wanna see what the deal is throwing off, right now, and the IRR and the upside. I see that as just kind of icing on top, and who knows, because we're speculating on a cap rate and all that.
What's my cash flow
and I
right
get
now?
that, but it's also you're only looking at half the whole picture, and it's hard to compare a bond or a money market account of like there's no chance for upside.
That's right.
And there's reinvestment risk. Short-term bond right now. Okay, what are you going to do in 6 months? Or a year, or in that money market account, if rates decline, and then the real estate market is probably going to be taking off, and you've missed your opportunity.
You missed the opportunity, yeah.
And so it's a balance for sure. But the other challenge is, and it's also an opportunity, is on the preferred equity that's out there, because there's a lot of preferred equity that's floating around, trying to get placed because they're charging a total return of 14%, 15%, which is higher than the common equity returns that we're seeing on a lot of deals. But the pref equity is technically lower risk because it's in a preferential position, behind the first mortgage. And so I'm like, if we're trying to go out and convince folks to invest as common equity with relatively uncapped upside, but we can only pencil to a 12 or a 13, they're like, well, I can go in this deal over here and I can get 14 and I'm in a priority position. I'm like, well, but we're really going to knock it out of the park and it's going to be a 25. And I'm like, well, why isn't that on the spreadsheet? I'm like, well, because you'd laugh at me if you saw the assumptions.
Yeah.
Right.
So so it's just an interesting, dynamic out there. And the one thing I'm certain of is no one knows, and it's that uncertainty.
Absolutely.
Is just
If they tell you that they
slowing
do,
things down.
then you know that they're a liar.
We know that. Yeah, they're full of it.
Yeah.
And so it's just dealing with the psychology of trying to make decisions when we don't know what the future is going to hold, and it's certainly a fascinating world we live in.
Yes,
It changes every
it
day.
is.
And I think Spencer kind of hit on it, especially with the common versus pref equity. But I remember you and I were having a conversation with one of our investors, kind of doing a quarterly review. And I remember them specifically saying, we were talking about, okay, how does this compare to deals you brought me 2-3 years ago? Like, what's that kind of year one? Because they are heavily looking at that. And we were saying, well, it's 5.5, it's 6. And they're like, well, wasn't this one like 7.5? Well, yeah, interest rates have changed. And the thing he said that really stuck out to me, he's like, yeah, I remember when stuff was 6, 7, 8% year one. And when that was the case, my money market account was almost zero.
That's
Money
right.
market accounts now are 5%. Where's my spread again? And it goes to what we've talked about here of like, what's that risk adjusted return, because real estate's so illiquid. And so that's been one of the real hard things that we've been trying to dial in with balancing of, okay, really great asset here, maybe a little bit lower return, but we know that people are going to rent there. Like, we all kind of know those markets right now in the Indianapolis area where it's like, I'd pay about anything to own that apartment complex. But you also know one where it's like, yeah, I really need cash because it's probably not going to appreciate. And I think that's the balance that we've been finding as we look at deals of what are we going after? Are we going after the one that is going to throw off the cash flow, knowing that, especially because we have our own management company now, we're probably going to be a bit more management intensive on, or are we going to go for one that returns are going to be a little bit lower, but we understand kind of what that lane is, the investors are going to drive by it, or if they come visit us, we take them to that and say, I'm glad I own that.
Yeah.
That's right.
And so I think that's one of the kind of psychology things that we've really been doing as we kind of look at that criteria. And so when Spencer says, do we have criteria? Yeah, we do, but it also depends on what kind of deal. Like, for a Class B deal, I'm going to need a much higher risk-adjusted return than I am for a Class A deal. And I think in the last couple of years, that's one of the things that I haven't seen as much because everyone's trying to place money, and it's I don't care if it's A, B,
Yeah,
or C.
they really condensed. Yeah.
It didn't exist.
That's right.
Every
That's right.
property was selling.
Yeah, it was, and it was a little bit of a head. I mean, I understand, your value add. You should have an opportunity to force more appreciation. You should be able to move the rents higher. But then we all saw you were getting similar rent bumps on the new Class A deals.
That's right.
And so it was like, okay, well, Villa's the first deal up that we were talking about. it was the same case. It's like, this doesn't look like a deal that should be so profitable. And then if you can make that happen repeatedly, which you can't always do, but if it's possible, why go through, some of the brain damage of, more of the workforce and renovating, right. And it's not a good, really great use of our time, because some of the B, C class stuff take up the most of our time from a management perspective.
Right.
So, but just on that, it's interesting though. I just was looking at a Yardi report. Indianapolis, you guys know. We've been on, top 3 or 4.
Still strong.
I know,
Still
for over
strong.
a year and a half. That's right.
It's wild, and it's relative to supply, but we're number 1 in the nation on I think there was September report for renters by necessity rent growth. We're at this is month over month, not year over year. We're in the top 4 for year over year on everything. But renters by lifestyle renters, they call them, the Class A, we're at the bottom of the list. And it's fascinating. We're still overall in the top 4, but it's because of supply, dynamics.
Yeah, that's right.
In every market is. In Indianapolis is. And we've got, call it, I think 6 to 8%, of supply, new supply compared to percentage of existing inventory. Compared to the Sun Belt, it's a fraction.
Oh, absolutely. Like Nashville or anywhere else further south.
Boston.
And that 6 to 8% is a big increase for us. We were historically, for a while, we were 3 or 4%.
Yeah.
But we had a pretty decent bump up in new construction.
Yeah.
And it's still a sliver of our overall supply, of our overall unit count.
And I see, that's leading to, I think, some short-term, headwinds for, rent growth in that segment, just because we see the concessions starting to come out more, starting to see the $1,000 gift cards, at signing. But all that is, short-term. That's it's going to get absorbed. And you just have to be okay with, a year and a half of it just being, relatively slower. But then again, I think there's a really bright light at the other end of the tunnel, that there's not going to be hardly anything else around, and still an incredible amount of demand.
Right.
I think we're on track for over 400,000 units being absorbed this year
Nationally.
But which is way more units than is typically delivered. We were delivering 300,000 or so a year. It's just we happen to be delivering 500,000.
Yeah, because all of these properties started in 2021 and 2022.
The money was free.
When the money was free.
The money was literally free. What else would you do?
Right. And we have really only one instance I could think of where somebody built a new property and they got 90% leverage.
Yeah.
So they only had to come to the table with a very relatively small amount of money relative to the overall size. And now to go get a construction loan, you're getting, I've seen under 60%, 55, 58%, more like 60, 65% for experienced developers. But it has been, and a lot of the banks that were lending on new construction, they say, I'd love this great project and I'd love to lend, but I have enough on my books right now that are going to stay here longer, because we thought we were going to get refied out before the end of our time period, or we thought they were probably going to sell, and that's not happening. So we've got enough multifamily real estate on our books right now that we have to pass, even though they don't want to.
Yeah, I believe it. Yeah, it's the carry cost for the developers. It's doubled, at least in terms of debt service that they, anticipated. You started paying 0 plus your spread, and now you're paying, 5% plus your spread. So,
right.
You were paying maybe 3.5, and you're paying 8.
Yeah.
And some change, and that's serious. And then the longer it takes to lease up, if you can't get your electrical switches from China on time, and you have to wait on your CO, that those extra couple months are critical. And so we've seen in a couple markets of where it's pretty obvious developers are really just heads in beds. Let's get stabilized so we can get refinanced, or we can sell, and which makes sense in the short term. But again, it's just I think there's some short term headwinds that we have to get through, and just kind of ride along with it for a minute. But if you've got a long term strategy, a long term business plan, and you've executed and financed that way, you're going to be in a good spot, and you're going to make a lot of money, 5-10 years from now.
Right.
It's just if you're had a very short-term strategy with no exit plan, and a lot of people made the same decision. It's not like anybody, messed up or made mistakes. It was very attractive at the time. Rates seemed like they were going to be lower, and rents were, rising by 20 to 30%. And maybe they weren't going to continue rising like that, but we didn't know. No one thought they were going to go negative. And there is still a ton of demand for apartments. It's just now we're all building at the same time. But much happier to be in the Midwest.
Oh my gosh,
and
yes.
Indiana than in the Sun Belt, which is really where everybody was going. And not for you guys. I mean, Indy has been just. When I first started going to NMHC, no one mentioned the Midwest. There was no presentation. It was the West. It was the East Coast. It was the Sun Belt, and then it was like the Midwest slides. Like they were there, but they just like skipped over.
They didn't even. Yes, So I've been selling apartments for a little over 20 years. Most of that has been in the Midwest. And to your point, when we would go to national conferences, and we didn't even. 15 years ago, we really didn't even go to NMHC because nobody wanted to talk about Indianapolis.
Yeah.
And all the local groups would come to us, or we would go roadshow to them.
Yeah.
But it's so great to be the Midwest is really on the map, and specifically Indianapolis has been on the map. It's even 10 years ago it started to change, but the last 5 years it's been pretty incredible that Steady Eddie has been really attractive, and then throw in our rent growth. It's been awesome.
It's like you get all of the growth. I mean, the suburbs of Indianapolis grew at the same rate as the fastest growing submarkets in the Sun Belt.
Or faster.
Yes. But we didn't see the declines like in 2020. We were still positive. We're still positive right now. It's like we just stay in this band. But then at least historically things have changed. But like you could still get a discount for being in the Midwest because nobody knew about it. And it was the best of both worlds, but just no one was paying attention. It's like the classic example of just kind of market inefficiencies of just people didn't know, and all the money was flowing to the Sun Belt and overpricing those markets, where we've got this great growth, tax friendly, business friendly,
very business friendly,
just dynamic, great city to be in. It's affordable. And people are paying attention, now, more and more and more.
It was funny in 21. How many times did you get the same call where it's either someone from New York or the Southeast, and it's New York? It's like, hey, we've always invested only in New York. Now there's rent control. We're looking to the Midwest where it seems to be very landlord friendly. Or we historically always bought in the Southeast. We're getting priced out on every single deal.
That's right.
We want to look at Indianapolis where there's probably not much competition, right? It's like, actually, you're the first, like the fifth guy to call this week or whatever it is.
I know.
I spoke to an investor, and she wasn't just a multifamily. She invested in a lot of different things, and she was from I think she was from Singapore. No, she was from Vietnam originally. She lived in Singapore. I was telling her we were invested in the Midwest, and she was like, who lives there?
You're like a farmer?
What do they do?
First of all, I do.
Yeah.
First of all, me. Yeah, the person you're on the phone with.
Before you say anything else.
I know. Yeah. Don't argue.
I remember my wife Alex. She went to college in New York, and then she always tells a story of like her freshman year. She said that she was from Indiana, and she was asked, did you grow up on a farm, and do you have internet yet?
And are you dating your brother?
Yeah. And she's like, well, she's like, my dad grew up on a farm, okay, but I didn't. And yes, we've had internet for a while.
We've had internet for quite some time.
About the same time. And so, which is all, it's a love line under the radar, and it's great. It's always hard because you want to tell people, you don't want to tell people, but it's, you guys we talk about it every week on the podcast. We love, cheering Indianapolis, one, because we're just genuine. We love the city, and we're cheerleaders. We want to see it grow, and we want to, I don't know, it's hometown bias. But that you had that hometown bias, though, almost like clouded my vision for a long time. Because I was like, Indianapolis can only be so good. I'm just biased because I'm from here. And I heard other people telling me, and we started looking at other markets.
Right.
And I started studying other markets, and I was like, Indy is a great market. I was like, our suburbs are incredible.
Phenomenal, yeah.
I was like, why do we want to go anywhere else? I was like, the green pastures are right here. And I don't have to get on a plane. Let's just keep doing it.
Yeah.
So, it's right place.
Well, sticking with growth, we'd love to hear about what you guys are doing for growth. I know you've talked about doing, I know you have in-house management now, but third-party management. We talked a little bit about your fund to acquire new construction, but where do you guys really see your growth over the next 6 months, year, 2 years?
the one piece that I'm most excited about right now, and it's not like growing in a sense of like we're going to buy, you know, $1 billion of real estate over the next, you know, couple of years, which that's the plan. We'd like to do that also, but it's this: if we can put together the best tech stack from a management perspective, because the one piece that we all know is real estate is just relatively antiquated. Not that there aren't really good operators out there. There are really good operators, but we're all living in this changing world that costs have risen, payroll has risen, and we need to find ways to do, you know, more with less, and also admit we're not really necessarily doing a lot of the things really that well today. It's just the way that it's always been done, and we're asking a lot for people that don't necessarily have all of the training, all of the experience. We're asking a lot of property management personnel, and not always giving them the right resources. And so to find, you know, we're actively working and experimenting with different technologies, different systems. So if we can leverage technology, you know, I know AI is a buzzword, but using technology in the right places, you know, a lot of them on the leasing, follow-up, automating that process, creating a seamless, you know, renting experience. If we can improve, because like the average renting experience like today isn't like that great.
That's right.
Like it is. There's so much friction. There's fees, and from the property management personnel, it also like isn't a great experience.
That's right. Yeah.
And it's a problem that has been easy to ignore the last decade because everyone's been making so much money. It didn't matter.
Right.
Cap rates keep compressing. The operations can be whatever because there's some rent growth there. You know, expenses, okay, it's fine. We sell it, you know, we make it a 30 IRR. Who's complaining? Why spend the effort to do anything? Now it's not a choice. It's something we have to do because costs have gone up so much.
Right.
And so we have to operate differently, and we don't have it all figured out, you know, yet. But it's, to me, if, you know, that's the vision, you know, that's the goal, and again, don't have it all figured out.
Yeah.
That's what I'm excited about. And if we can do that for ourselves, we can find a way to roll that out to other groups, whether that's through third party management or, you know, kind of licensing, you know, the proprietary system that we put together. That's what I'm really excited about. Yeah.
It's such a multifamily ownership and operations is such a unique model that often you have somebody who's basically running a 50, 60, $70 million business.
Yeah.
Maybe without the resources that they need. You know, your property manager, maybe they've got a couple of years of experience in leasing and an assistant, but they maybe don't even understand how the financial metrics work as it goes into the value of the property. But that is the person who, at the site level, is running the business. And if they don't have the tools or the training, which often they don't, it can have a major impact on the operations of that property, and then ultimately the value of the property. So the operators that we see do really well, and you guys absolutely fit into this, is they know everything about their properties. They know everything about the operations. They know where rent levels should be, and they properly equip their staff on site and otherwise to be able to operate the properties. But it's such a unique model, and I don't think there's a lot of them out there where it's like, hey, this is a $50 million asset, and somebody on site who makes $50,000 a year, $60,000 a year is operating it.
Yeah.
And I think to even take that a step further, Spencer and I have discussed this, and I actually had this discussion with NMHC. We think about leasing kind of like, oh, it doesn't matter if it's $500 a unit workforce housing up to a $3,000 a unit Class A property. What you're actually doing is you're selling a luxury good, because that $500 a month lease over 6 months is a $6,000 purchase. So you're asking someone to make a $6,000 purchase.
Yeah.
Where else, when you do a $6,000 purchase, like, what is the experience of that anywhere else that you buy something for $6,000?
Right.
Like,
and that's on the
lowest
end.
Yeah. Yes, if you can find me a $500 rent.
Yeah,
yes.
yeah.
I think you're talking about at like $8,000 or $9,000. Yeah. To your, but I get the example.
20. I mean, it's $15,000, $20,000. You know, yearly purchase.
Annual, yes, annual expense. That's right. That's such a good point.
And so we don't think about it because we just think about the real estate. We think about, okay, the value, all that, to what you said from that, hey, it's a $50 million business, but then from the consumer standpoint, they are buying a luxury good. Like, are you going to go to Coach? Are you going to go to Louis Vuitton? And like, what is that experience like?
Oh, yeah.
Here comes the glass of champagne.
That's right.
Walk around, you know.
And I think at our Class A properties, maybe we treat it that way. But if you think about it from a percentage of income standpoint, like that's all the way down what you're asking someone to pay.
Yeah.
And that's where it's like, okay, where do we have people, and like, are we inserting the human element at the right moment, or are we letting the human kind of mess up like the process also? Because like, we're never going to be able to replace all the people, because we need to have that good experience. No one just wants to work like with like a robot or online.
Yeah.
But if we can make the process really easy with technology, and then then cap it off with a great human personal experience, and that way that leasing consultant who is leasing consultant are typically relatively entry level positions, and so to think that they're going to be able to do all the follow-up perfectly and then also have a great personal interaction, it's asking a lot. If we could just focus on just being nice people, really doing really great tours, knowing how to sell, knowing how to close, but working on the people, the human part of it, and just again, a lot of the follow-up, a lot of the details that mostly can be automated or centralized, in the corporate office. Like, let's just focus. Let's allow people to do what they're best at, and where they can move the needle, and not just kind of set them up for failure. And then also the result is we probably don't need as many physical people doing it.
That's right.
Because like, how many tours are you actually doing? Giving a week.
Right.
It's not always that many physical tours. Especially if you can do virtual and online tours and leasing. Right. And so it's like, you can provide a better experience, with less.
Yeah.
In many ways, you're more comfortable actually working with AI now. Or like even like DoorDash. I would rather order food off DoorDash because I'm more comfortable looking at the menu. I can pick out what I want. I'll customize the food.
Yeah.
If I'm calling, it's like the person's like, what do you want?
Yeah.
It's like not a great experience.
Yeah,
I can't hear you.
Yeah.
I know. Can you repeat it again? Yeah. And you also often you don't get the check, like you can't check to make sure everything's right. You can see it right there on the app. Yeah.
Exactly. But I feel like the industry, and again, there's people that are building great systems, and not everyone's in the Stone Age. But the idea that we are pushing more of it on a person, that you have to physically call in, or you're going to fill out a form on a website, you're going to wait for a phone call. It's like, if you can't do everything just online, where what century are you
Well,
operating?
and for somebody who's paying $2,000 a month, they have a job.
Yeah.
I mean, if you're a nurse. I like you're like, wait a minute. I hope so.
We dealt with that too.
But if you are a nurse and there's no you don't have your phone with you, or you're not sitting at a computer and you're working all day, it's difficult to try to lease an apartment that has hours between 10 and 6, because that's when you're working. So if you can't do it after hours or early in the morning or quickly on your lunch break, it makes it difficult for people.
The office hours of apartments is interesting because again, so we brought property management in a little over a year ago, and from using third party, and so there's a lot of things I'm like, I'm not the expert, and so I'll defer to the expert. But then the more you learn, the more you do it, you start asking questions.
Yeah.
And it's like, so we're only open. We're open when everyone else is working.
Right.
Like when no one's available.
Yeah.
How does that make sense?
Yeah.
Like, okay, we're not open on Saturdays. I get it. Nobody wants to work Saturdays, but just when would you go to tour? When would you even be available to go and
be available? Right.
It's
yeah.
on the weekends.
Yeah. Or later in the evening.
Or later in the exactly later hours, and so it's there's a lot of kind of copying and pasting in property management, just kind of doing the same thing, and again, because it's worked out fine, if it's not broke, don't fix it, I guess, which is why I think it's just really exciting that we can just do things.
Yeah.
better.
That's what's great about times like this where there's headwinds. And so on our team, we have people who have been in the business a year, maybe 2 years, all the way up to George, who's
Yeah.
over 40 years. And so being able to look at it from a different perspective of like, hey, this used to work really well,
Yeah.
but it doesn't work right now. And so we've told our younger people on the team is, this is actually like you guys got into it when COVID started. Like that's a great
Yeah.
time to start. This is a great time for young people to get into real estate because it's not easy.
Yeah.
And it'll set you up to be able to pivot and to think about things outside of the box and to think about things more strategically, not just the copy and
Yeah.
paste. And so you guys have done that in so many different ways in both your operations and how you've acquired and grown. And so it's been so fun to see.
Oh, thank you.
Cameron, I think I was in the conference room. So one of the first deals the first deal that you guys bought.
Yep.
And the
Yeah.
first deal that you sold, I should say. The first,
Yeah.
was it
Yeah.
both?
Yeah, it was, it was
Autumn
the first.
Trails was the first one we closed on.
Okay.
Okay.
We went under contract
Contract on
yeah.
Pinnacle first, but
So basically, they
yeah.
were basically at the same time.
Yes.
So, yeah, first.
Well, for the first deal you guys sold.
Yeah.
So I joined Cameron for the presentation that we gave you, and I was sitting there listening to Cameron, and he's like, I love your company. I love everything that you've done. I listen to all of your podcasts. I read all the materials you put out. And he's like, I want to be the person who sells you your first property because your company is awesome and I want to be a part of it. And I was like, yes, that is right. They
And to be
are
honest,
awesome.
You actually won the listing in that meeting because when we BOV'd that, you guys were doing numerous transactions that year.
lot of big deals.
And so we're
You
like,
guys
okay,
Yeah.
this is a smaller deal. Like we bought it for 10 million. I think we ended up selling it for about 14. And so we're like, okay, compared to they're bringing us up 30, 40, 50, 60 million dollars. We're like, okay, like they've got that bandwidth. We'll take it. And we had 3 other people BOV it.
Yeah.
And everyone had a very, very similar pitch. They told us, hey, this is kind of the pool of buyers you're working from. Here's kind of your numbers. They were coming out in the same like range of pricing. But I remember sitting in that meeting and Cam laying all of that stuff out, and I was like, if I need someone to sell a property for me, like I can't choose anyone else.
Yeah.
And I remember Jay and I having conversations of saying like it just would Cushman do a great job? Like of course, but like maybe it's just not the big enough deal that they're going to want to put the effort into it, and they're going to be busy, and there are probably going to be some other groups that they'll be a little more hungry, and. So far, you guys have number 1 market share, in Indiana, by far. And like we said, Cushman won, Ticketron Associates number 2, which is who you guys were before we went to Cushman. There's a lot of other great brokers
Yes,
in Indy that we
100%.
really like, and we want to do more business with those guys
Of
as
course.
well. But it's a different experience. You guys don't rest on your laurels and just like assume like we're the best. If you want it sold at the price, you're gonna have to give it to us. You guys work and put the effort in for every single deal and put in 110%. And we've been on the buy side and the sell side, with you guys, both, from the Great Capital deals to, all the other deals that I've done outside of Great Capital, and you guys just bring it every time. And so, Jay and I, we were hoping to give another group a shot because they're not going to want it, but then you guys wanted it the most,
That's right.
Yeah.
and so
That's right.
it just it
But it was
shows.
because we really wanted to be part of your company.
Yeah, well,
because
we
we've
appreciate
loved
that.
to see your success, and you also just not only your company but your culture and everyone who works here and the way you guys operate your business. It's so fun and refreshing to be part of that. So it was a compliment to you guys that it was so important.
we appreciate that.
For you guys to get the deal. So.
I've got the deal book up on the
Yes.
on the shelf.
Yeah, I know.
I love
I know
it.
that was an awesome deal.
Yeah.
We're so excited to be a part
Yeah,
of
and
it.
that was a unique one too.
Yes.
Very unique, and the timing. We didn't really intend to time it like that, but it ended up working out really,
perfect.
really
It
well.
worked out great.
Yeah.
But I remember even standing in the hallways there talking about technology now. You're like, we could have done Roombas in here too instead of cleaning the hallways every 2 weeks.
I know.
And
Yeah. Oh yeah.
we
So
laughed
many.
about that for a long time.
Yeah. Roomba's. I've seen it done. It can work.
amazing.
It can
It can be done.
can be done.
Well, it was great talking to you guys. And remember what George always says, you're only as good as your next deal.
Absolutely. Thanks, guys.
Yeah,
Thank
thank
you.
you. Yeah.
Good stuff.
Thanks for tuning in.
Stay in the loop by hitting that subscribe button.
And check the show notes for additional resources.